etc. Pratik Gupta is with us, CEO and co-head Kotak Institutional Equities. Pratik, liquid oxygen comes to mind. Is that still liquid oxygen or oxygen liquid? And does that make a difference?
Yeah, unfortunately, Prashant, we're still in a range-bound market. Basically, as you've been seeing, the earnings growth outlook is still pretty tepid for this year. At Kotak, we're projecting about barely 9%, 8.5% earnings growth for the Nifty this year. And also the foreign sentiment still remains very, very weak. That's one big factor that's keeping a lid on the markets over here. We're seeing continuous selling by the foreigners. And frankly, that's partly, we're not an AI play. The other markets are doing much better. Growth in India versus the valuations over here are not so attractive. So valuations in Nifty is still trading at about 21.5 times FY27 earnings, which is still expensive. So despite this pretty severe underperformance of India in the last 1 year, we are still trading at a 60% premium to the MSCI EM index PE. So investors are, it's okay. It's not like investors are looking at India and saying, okay, India's become cheap. We're still sort of, just about reasonable valuations, if even that. And when many stocks in the markets are still somewhat expensive. So we're still sort of range bound. We have to go through probably another couple of quarters of an earnings catch up, and we'll stay in this liquid oxygen mode, I guess.
Pratik, this AI business, actually, we can go on about AI. Let me ask you the more pressing question first before we run out of time. Rupee, is that come up in conversations with clients?
Yes, of course, especially with foreign investors who are benchmarked in dollar terms. Just to put some numbers in perspective, the rupee has depreciated by almost 5% year to date. And the the Nifty's performance, if you take that as a benchmark, we are up about 10%. But 5% has been taken away by the rupee. And so in dollar terms, India has delivered only about 5% dollar terms. Now, you put that in the context of the MSCI EM index, which is up some 24, 25%. There are markets like Korea, which is up almost 70%. Brazil and Mexico are up 30-odd%. Taiwan is up very sharply, 40-50%. Even China's done quite well. So we're really standing out, not just in terms of the absolute performance in local currency terms, but also the rupee. And the rupee is also leading investors to hold back on any incremental investments. As it is, the crib is valuations are not particularly expensive. And is the rupee a tool which is being used by the authorities to try and stimulate the economy? So is there more downside? Can the rupee slide by another 1 or 2%? So that's sort of, there's no rush to sort of buy India. And especially as we get into the year-end sort of month as well. Yeah. That's also impacting overall flows into India.
Pratik, morning. Forget buy India. I had the other question. I mean, don't call me a bear, but I'm just wondering if this becomes a new risk. Because of 90, and then people are calling 91. If these kind of levels happen, then anyway, you're not making returns in India. Your dollar-denominated returns diminish that much more. So my worry is this year, we've seen about 1.5 billion, last count, 1,45,000 crores of FPI sales this year. And the whole premise is that next year the FPIs will come. Is that premise itself at risk, or should we not be so worried, at least right now?
I think the rupee in itself will not be the main driver of whether FPIs come back or not. That would be a sort of side argument. In fact, our estimates suggest that, frankly, this week's, the last 10, 15 days, the decline in the rupee is more driven by sentiment. We had the trade deficit data that came out. The FPI selling continues, and it looks like the RBI is the one which is sort of stepped aside from supplying dollars into the market. That's what's causing the decline. I think that's lesser of a concern. We think the rupee there's not that much more downside. Current account deficit is still projected to be about 1.3%. We still have a fairly healthy forex reserves and so on. The bigger issue is, one, what's happening with the trade deal? How much longer, if at all, and also at what kind of terms will we get the trade deal? So that's the bigger issue in the minds of investors.
Yeah.
The second is the AI issue, which is anyone's guess. This thing can go on for another 6 to 9 months, in which case India will continue to underperform. And in that case, you will continue to see foreigners selling India and also, like I said, we are still not a cheap market, 21.5 times 1 year forward for 9% earnings growth this year. And yes, next year we get slightly better earnings growth, FY27. By our projections, we're estimating about 16-17% earnings growth, but still not as exciting as what's happening in some of the other markets.
Yep.
So you need a lot more growth coming back into the economy before foreigners come back.
No, absolutely no. I completely take your point, and the only reason I asked that was exactly what you said. If the currency is going to be used as an instrument to provide a cushion against the lack of a trade deal, to cushion the exporters, it's a very strategic move. Then it's no longer, a question of one speculator here or there. Then maybe it's more than that, but we don't know. I think the coming days will tell us and give us the answers. So given all of these challenges, Pratik, the question is what to do in this market. You can't be all bleak, right? Also have to find out some cheerful notes here and there. So where's the cheer?
No, unfortunately, not too many pockets. This is a time when you sort of have to protect your capital, not worry about the return on capital as much. So that's why I've been saying you're now sort of the upper end of what I call the liquid oxygen range, the range bond market we're in. So you're sort of at the upper end right now. At this stage, you'll be slightly more cautious, stick with the somewhat companies where you have greater earnings visibility, relatively more valuation comfort, companies which can withstand the slow growth patch a lot better compared to their peers. So one is sectors, and second is by size. So sector-wise, we generally still like the domestic-oriented players than the export-oriented players, whether it's the IT companies, IT services companies, or the generic global pharma exporters, or the auto ancillaries, which are heavily dependent on exports. So stay away from those, focus more on the domestic plays. And second is the relatively large caps or larger players within each industry versus the smaller players, where again, they will probably go through a tougher time in an economic slow growth period, in a slow growing economy. And the larger players would be somewhat better positioned. So again, brings us back to some of the banks, some of the NBFCs, some of the airline company. There's only one which is really worth investing, Indigo. The hotels, healthcare space, pharmaceuticals, more the domestic-oriented farmers, and so on, telecom. So that's sort of have somewhat of a defensive tilt at the upper end of the range, is what we're saying.
All right. Hi, Pratik. Good to see you, Ben. And you've said this in the past, large private sector banks, large PSUs and NBFCs, that's something that you've liked. And, though I think you're not very positive on the tech space for the time being, I think what the street is catching on to is that the rupee weakness could in turn be good for them. And as we know, the tech index has been a big underperformer. So that's one of the indices that are actually at the high point of the day. Well, Pratik, before we let you go, just leading up to our next conversation, we have an auto name, OEM, that's going to be joining in, Bajaj Auto. But auto ancillaries is something I think that you're a little bit skittish on. How are you positioned currently on auto as well as on auto ancillary?
So autos have done very well. I think obviously helped by the GST cuts, which was a big factor for many of the auto OEMs in particular. And but most of them have already played out. In fact, we're already seeing signs of demand weakening post the initial GST bump up, and the post-festive demand is also sort of beginning to soften a bit. And keep in mind, auto demand is going to be a function of the overall consumption growth in the economy, which is still very weak. We don't have enough jobs being created, or income growth is being somewhat weak. So therefore, in that context, it's tough to be very positive on the auto stocks, especially after the rally. We frankly, at this point in time, amongst the OEMs, we like only M&M. We prefer the four-wheelers to two-wheelers. Two-wheelers, we think there is the other challenge of the EVs and more competitive intensity and so on. There are some companies which are somewhat better positioned from an export perspective, and the rupee depreciation does help. But bear in mind, it's when the overall global growth economic environment is quite weak, tough to be very bullish on the exporters, especially if those who have exposure to the US. So as far as the auto ancillaries are concerned, I think it's time to be very, very selective. There are some who have huge exposure to the US, and given the uncertainty over the trade deal, we'd be a bit cautious. Again, we would prefer the OEMs versus the auto ancillaries.
Got it. Pratik, thank you very much for joining us on AI. I started raising the question in August whether we are seeing a lot of selling because there's no AI plays here. But a lot has happened since then. DeepSeek, for example, I don't know if you saw the news, has released 2 new models recently, which they say is about 25 times cheaper than ChatGPT and as efficient. So who knows where value will finally settle in that, right? In all of that. Maybe the adopters will be the winners. And I'm actually starting to wonder if the Indian guys and not just IT companies, but banks, etc., will be the adopters of AI, will eventually reap the benefits in terms of higher margins at the expense of lower labor costs, etc. But we can have this discussion. Thank you very much for joining us. Really appreciate you being here on CNBC TV18.